I'm in San Antonio for NAREIT's REITwise, our 2019 Law, Accounting, and Finance Conference. Joining me today is Kathy Miller, Senior Vice President of Financial Services and Tax with Regency Centers Corporation. Kathy, thanks so much for joining us.
Good morning. Thank you for having me. Glad to be here.
Now, here at REITwise, you moderated a session focused on state and local tax issues. In your opinion, what's the most pressing tax issue on a state level that REITs are facing this year?
You know, Matt, from a strategic viewpoint, I think there are a couple of things we ought to keep our eye on. And I think the strategic, are things that can change the business or change the scope of what a company is trying to do. One of those is the proposed legislation in Hawaii, where they are trying to get away with the dividends paid deduction. If that happens in Hawaii, that's meaningful for anybody that's doing business there. Now, it hasn't passed yet, and we're watching it closely. So obviously, the big fear is what if other states follow, but that certainly has an impact on how you can run your business. California has taken a pretty active stand in trying to raise revenues as well. They have the split roll initiative, which is where they're trying to repeal Prop 13. Prop 13 limits the amount your property tax can increase every year to 3%. Split roll means take residences out of it to get the homeowners to vote for it and raise property taxes over 3 years up to full value for businesses. Again, increases the cost permanently for the businesses in California and for their tenants if they pass them through. Probably less strategic, but also very cumbersome is tax reform.
And speaking of tax reform, what are the biggest implications on a state basis that REITs should keep in mind based on that?
You know, the truth is it varies state by state. The states, there's no flat rule that says every state has to adopt federal, and so some adopt the changes real time, some adopt it when they get ready to, some adopt some of the provisions, not all, and some don't adopt at all. So there's no one rule for the states other than you've got to do your research and just, figure out where they are and what the next steps are.
And lastly, on a personal level, what have you learned in moving from a pure tax role to a more general business role at Regency?
About 10 years ago, I was blessed with the opportunity to start overseeing some other departments, including our underwriting and due diligence departments and FP&A, the forecasting and analysis. The underwriting and due diligence is just really fun. Our team works up through the CFO. We're not deal guys, but we make sure that every project where more than $1 million is spent, our team is involved, and we make sure every project is underwritten with the same guidelines, whether you're in California or you're in New York, and that all of the underlying assumptions and thresholds that have to be met are met. So we work with all the teams to make sure that what the deal guy brings in and says we're getting is in fact what we're getting, and that really helps on the tax front as well. A great example of that is we have a property in Maryland that we're about to redevelop. It's a giant anchored grocery store. We're going to build a new giant strip center, move them over, demolish it, and then sell to a multifamily developer, partner with a multifamily developer to build and sell townhomes. REITs can't build and sell townhomes, so it has to be in our taxable REIT sub, and we have to plan ahead. So being involved on the business side of the equation much, much earlier than before has really made it a lot better for me on the tax front, so we can be a lot more prepared.
Great. Kathy, thank you so much for joining us.
Thank you. Always a pleasure.
For more information on this and other REIT news and analysis, be sure to visit NAREIT's website, REIT.com.